I've told students, if when they got out of school, they got a punch card with 20 punches on it, and that's all the investment decisions they got to make in their entire life, they would get very rich because they would think very hard about each one. And you don't need 20 right decisions to get very rich. 4 or 5 will probably do it over time.
Ready to turn your couch change into a fortune? Forget rocket science. Warren Buffett's got 3 simple investing rules so easy, even your pet goldfish could follow them. Whether you're broke, confused, or just tired of losing at Monopoly, this beginner's guide will have you feeling like a Wall Street wizard in no time. Stick around, because making money shouldn't be rocket science, but it sure beats your last snack choice.
Who's winning in this economy right now?
The rich. Guys like me. We have gone from having 93 billion, top 400, in 1982 to having 2.4 trillion, 25 for 1. People who, it becomes a more and more specialized market economy. It was an agrarian economy a couple hundred years ago. It's very hard, to get 20 times the wealth of the next guy because you were a little bit better farmer. But if you're better at some skills now, you can become incredibly wealthy at a very young age, not because you earned the money to build one steel mill and then saved it to buy another steel mill.
Imagine starting your investing journey with a secret recipe so simple it feels like cheating. Yet it's the same recipe a guy who turned a paper route and a few lemonade stands into a multi-billion-dollar empire swears by. That's right. Warren Buffett, the Oracle of Omaha, didn't become a financial legend by deciphering hieroglyphics or attending Wall Street's secret handshake club. Nope. He stuck to 3 ridiculously straightforward rules that even your goldfish could understand if it had thumbs and a taste for compound interest.
Stocks are safe for the long run, and they're very unsafe for tomorrow. Berkshire, 3 times since I took over, has gone down roughly 50%. Did I feel poor then? No, not at all. I knew it was going to be worth more over time. American business is going to be worth more over time. That's what you're buying as a business. You're not buying a stock. You're buying a piece of a whole bunch of businesses. Are those businesses going to be worth more 10 or 20 or 30 years from now? Of course they are. But if you think you can jump in and out, or that the time to come in, I think you're making a mistake.
Wait a second. Loving the video? Let's make it official. Hit that subscribe button and stay tuned for more exciting content, because the best is yet to come. Now let's head back to the video. Let's talk about why investing feels like walking into a casino blindfolded, except with your life savings instead of poker chips. The stock market isn't just a place where you can buy a piece of your favorite coffee company. It's a labyrinth filled with intimidating charts that look like alien code, a flood of buzzwords that sound like a failed Scrabble game, and headlines screaming market crash every other Tuesday. No wonder beginners treat investing like a haunted house tour, terrifying, confusing, and best avoided unless you're desperate for adrenaline or financial ruin.
There are 3 major categories of investment. The first category is anything denominated in a currency. It can be bonds, it can be deposits in a bank, it can be a money market fund, it can be cash in your pocket. And the second category of investments regard items that you buy that don't produce anything, but that you hope someone will pay you more for later on. And
most people either jump in, lose money faster than a politician flips promises, or freeze, letting their cash collect dust under the mattress. Meanwhile, Buffett's approach is like the chill grandpa at the family reunion who's seen it all, eats pie, and explains everything with stories rather than confusing graphs. His secret? Simplicity and patience, which, by the way, is probably why he hasn't aged in decades, while the rest of us stress over cryptocurrency memes.
The classic case of that is gold. The third category of asset is something that you value based on its what it will produce, what it will deliver. You buy a farm because you expect a certain amount of corn or soybeans or cotton or whatever it may be to come your way every year. And you decide how much you pay based on how much you think the asset itself will deliver over time.
Let's be honest. Investing feels less like a smart money move and more like voluntarily signing up for a brain-busting pop quiz you didn't study for. You open your browser and bam! Words like derivatives, futures, and bear markets hit you harder than your morning coffee. Stock charts look like abstract art painted by a caffeinated toddler, zigzagging up and down like a roller coaster designed by a sadistic mathematician.
Over a long period of time, they're going to go up. But in terms of what's going to happen in a day or a week or a month or a year even. I've never felt that I knew it, and I've never felt it was important. We're almost always a buyer of stocks, and we're a more aggressive buyer when they're going down. I mean, I feel much better when they're going down.
And just when you think you're getting the hang of it, the news drops headlines screaming, market crash imminent, economic Armageddon, or my personal favorite, buy gold and run. No wonder most beginners react like deer caught in headlights. Statistics don't lie. Over 70% of new investors either lose money in their first year or get so overwhelmed that they throw in the towel faster than you can say financial freedom. Some never even start because the whole thing looks like deciphering an ancient alien language mixed with rocket science. Enter Warren Buffett, the human equivalent of a calming hug in a room full of panic. While everyone else chases the next shiny fad or tries to decode cryptic financial mumbo-jumbo, Buffett is basically sipping tea, smiling knowingly, and reminding us that investing isn't about complexity, it's about simplicity and patience. No smoke and mirrors, no secret formulas, just common sense. His approach doesn't require you to binge-watch financial news or master stock charts that look like Jackson Pollock paintings. Instead, it's like being handed a map with 3 big, bold arrows pointing to where the treasure actually is.
We try to buy the ones that are. I mean, I bought my first stock in April of 1942. I was 11. Pearl Harbor had happened 3 or 4 months earlier. We were losing the war. I mean, if you want to talk about a bad outlook for the country's not going to go away. The plants aren't going to go away. The people aren't going to go away. The talents aren't going to go away. The country will grow in value over time. Now, who gets it is another question.
And that, my friend, is the breath of fresh air beginners desperately need, because investing should be confusing only if you make it so. So, what's rule number 1? Invest only in what you understand. Revolutionary, right? But before you scoff, imagine trying to fix a car engine without knowing the difference between a spark plug and a cup holder. That's what it's like buying stocks blindly. Buffett's early love affair was with a company that made car insurance, because he actually understood insurance. The man knew the business inside and out, which meant he wasn't just throwing darts at a board labeled stocks. This idea is called staying within your circle of competence, which sounds fancy but really means don't buy shares in biotech if your understanding of DNA is limited to TV crime dramas. If you're obsessed with tech gadgets, maybe peek into companies making those devices instead of random stocks you read about on a sketchy blog. Think of it like fishing. Stick to waters where you know the fish aren't poisonous or you won't get a bite. Your wallet will thank you.
Both, with opportunity cost serving as the final arbiter of which method to use, given that your investing opportunity has now broadened significantly. Thank you. Khop Kap.
Good question. I'm glad you came. And the answer would be, in my particular case, it would be going through the 20,000 pages. And since we were talking about railroads, I went through the Moody's Transportation Manual a couple of times. That was 1,500 or 2,000 pages, or probably 1,500 pages. And I found all kinds of interesting things when I was 50 or when I was 20 or 21. And I don't imagine there's anybody here that knows about the Green Bay and Western Railroad Company, but
it isn't some boring lecture. It's the secret sauce that turned a teenage kid who bought a couple of shares in an insurance company into the Sage of Omaha. Picture this: young Buffett, armed with nothing but curiosity, a few bucks, and probably a serious case of "I want to be rich someday" syndrome, stumbles upon GEICO. Now, why GEICO? Because insurance wasn't just some abstract Wall Street buzzword to him. It was a business he understood like the back of his hand. See, Buffett wasn't throwing darts at a stock chart or relying on horoscopes to pick winners. He dove into a company whose business model he got: insuring cars, collecting premiums, managing risk. Simple, right? That's the magic of the circle of competence. Imagine it as your own personal fishing pond. You wouldn't wade into a swamp filled with piranhas just because someone told you the fishing's good there. No, you stick to the waters you know, where you can spot the fish and maybe even name a few.
Warren Buffett, right now, 2 years ago when he was sitting on $125 billion of cash, everybody called him crazy. Right now, he's sitting on $105 billion of cash. Why would he sit on $105 billion of cash? He knows opportunity is going to come up. He's going to buy companies on pennies on a dollar.
For beginners, this means don't just blindly chase whatever's trending or whatever TikTok hyping this week. If you're obsessed with the latest smartphone or your life revolves around Windows updates, maybe start by learning about companies like Apple or Microsoft. You know their products, you understand their place in the world, and you're more likely to make informed decisions instead of gambling on random acronyms that sound like a bad password. Here's the kicker. The market's littered with folks trying to be experts in everything and ending up with portfolios that look like a toddler's finger painting, messy and confusing. Buffett's genius wasn't being a know-it-all. It was knowing what he didn't know and steering clear of it. So next time you're tempted to buy shares in some biotech startup because your cousin's friend said it's the future, remember the fishing metaphor. Stick to ponds where you know the fish won't eat you alive. Because at the end of the day, investing isn't about showing off how many fancy stocks you can cram into your portfolio. It's about smart choices, patience, and most importantly, knowing your limits. Buffett's first rule is a masterclass in common sense disguised as finance. Keep your circle tight, your knowledge deep, and your chances of blowing up your savings minimal. Now go find your pond and start fishing smart.
The best single thing you could have done on March 11th, 1942, when I bought my first stock, was just buy an index fund and never look at a headline, never think about stocks anymore, just like you would do if you bought a farm. You just buy the farm and let the tenant farmer run it for you. And I pointed out that if you'd put $10,000 in an index fund that reinvested dividends, and I paused for a moment to let the audience try and guess how much it would amount to, and it would come to $51 million now.
Rule number 2 is the one that separates the real investors from the "I saw a headline, so I bought this" crowd. It's all about thinking long-term, not chasing those glittery get-rich-quick fantasies that make the market look like a casino on steroids. Let's be honest, if investing was just about striking gold overnight, everyone would be a millionaire, and the news wouldn't be filled with stories of people losing their shirts because they bought some random meme stock at the peak of a viral craze. The stock market doesn't hand out riches like candy on Halloween. It's more like a slow cooker, low and steady heat over time that transforms raw ingredients into a mouth-watering feast. If you try to rush it, you end up with something half-baked. And your money? Well, it's the equivalent of raw dough, useless and disappointing. Buffett knows this better than anyone. He didn't just buy stocks and immediately cash out. He locked them down for decades, letting those investments simmer while the world around him flipped like a pancake.
Well, I think it's a terrible mistake if you're in the kind of business where you can do it. I think it's crazy. It'd be crazy for me to leave my job, assuming I can do it. I mean, if I quit today, I see these people. They spend a whole week planning their haircut. That is not my idea of living, you know. And I am fortunately in a business, you know. My muscles are gone, my balance is gone, my stamina is gone, but it doesn't make any difference in what I do. So I'm very lucky that way.
Take Coca-Cola, for example. Not just a soda, but a cash flow machine that Buffett has held on to forever. While traders were busy biting their nails over every quarterly report and market blip, he was calmly watching the dividends pile up, sipping on his Coke, and letting the magic of compounding do its thing. It's like planting a tree and patiently waiting for it to bear fruit instead of hacking it down for firewood the moment you get hungry. Data confirms this wisdom. The folks who make serious bank are the ones who resist the temptation to sell every time the market sneezes. They tune out the noise. Yes, even that friend who won't stop texting you about the latest Bitcoin moonshot, or that startup with a name that sounds like a sneeze. Patience here isn't just a nice-to-have quality, it's your secret weapon. It's like having a financial therapist who tells you to breathe, stay calm, and trust the process instead of binge-watching the chaos unfold. So, get cozy with patience. Forget the flashy headlines promising overnight fortunes. Real wealth builds quietly, stubbornly, over years and decades. Rule number 2 is your reminder that slow and steady isn't just for turtles, it's for anyone who wants their money to grow without losing their mind.
For investing a small sum today, which approach would you use?
I would use the approach that I think I'm using now of trying to search out businesses where I think they're selling at the lowest price relative to the cash they would produce in the future. When I started, I went through the pages of the manuals page by page. I mean, I probably went through 20,000 pages in the Moody's industrial manuals. And I did it twice. And I actually, looked at every business. I didn't look very hard at some. I would find one or two that I could put $10,000 into or $15,000 into that were ridiculously cheap. So I would say if you're working with a small sum of money.
Now, let's crank up rule number 3, value over hype. Because if you thought the stock market was a serious, buttoned-up place, think again. It's more like a Black Friday sale on steroids, except instead of fighting over TVs, people are fighting over shares in companies that may or may not survive next week's headlines. Your coworker who won't stop yammering about some can't-miss stock? Yeah, they're probably just hoping to be the first one to brag when it does go up, or looking for someone to blame when it crashes harder than their last Tinder date. Buffett's strategy here? Hunt for bargains like a savvy shopper in the clearance aisle. Companies with solid fundamentals that are just temporarily out of fashion. Imagine walking into a sneaker store the day after the newest hype model dropped. Everyone's scrambling for the latest flashy kicks, paying full price like caffeine-fueled zombies. But you, the smart shopper, are eyeing those perfectly good classic sneakers from last season marked down to half off. Same quality, less hype, and more bang for your buck.
And I'd like to touch on an earlier question about investing with small sums of money. I'd like to ask both of you, if you were 30 years old again.
Well, I'll be very simple. Under the conditions you name, I'd probably have it all in a very low-cost index fund, and it'd probably be, might be Vanguard, somebody I knew was reliable, somebody where the cost was low, and because you postulated that you're not going to become a professional investor, I would recognize the fact that I'm an amateur investor.
This isn't about chasing every shiny new thing flashing "buy now" in neon signs on your phone screen. It's about ignoring the noise and peeling back the curtain to see what a company is really worth. Forget the buzzwords and dramatic headlines. Focus on the numbers that actually count. Tools like the price-to-earnings ratio might sound intimidating, but think of them as your financial magnifying glass. They help you figure out if a stock's price is a fair deal or just an overinflated balloon waiting to pop. You don't have to be a finance wizard or have a secret Wall Street decoder ring to get this. It's just a matter of curiosity and willingness to dig a little deeper than the flashy headlines. Because let's face it, the market is full of wannabe hype machines, but the real winners are those who buy smart, stay patient, and don't get swept up in every passing fad. When you master the art of value investing, you're not just playing the game, you're playing it on your terms, with strategy, patience, and a keen eye for hidden treasures that everyone else is too busy ignoring.
I had a woman come to see me here not long ago, and she'd come on some money, not very much, but it was a lot to her. And she said, "What should I do with it?" And I said, "Well, what do you owe on your credit card?" She said, "Well, I owe X." I said, "Well, what you should do," I don't know what interest rate she was paying. It was something like 18%. I said, "I don't know how to make 18%. If I owed any money at 18%, the first thing I do with any money I had would be to pay it off. It's going to be way better than any investment idea I've got." And then later on in the conversation, she talked about her daughter, and her daughter had $1,000 or $2,000 or something. And she said, "Well, what should I do with the girl's money?" And
so how do you put these 3 rules into action without needing a secret decoder ring? Start small. Pick a few companies you know and like. No, not just the ones with the coolest logos or the ones your favorite influencer hyped yesterday. Open a brokerage account that doesn't make your head spin or charge fees that make you question your life choices. Use free tools to research these companies with Buffett's philosophy in mind. Focus on understanding, patience, and value. Remember, you don't have to be perfect. Buffett didn't become a billionaire overnight, and he's made mistakes too. The key is to start somewhere, learn as you go, and avoid the trap of paralysis by analysis. The market rewards action, but thoughtful action. Think of it as a marathon, not a sprint, where pacing beats speed every time. The Buffett mindset isn't just for Wall Street whales. It's a down-to-earth, no-nonsense guide that any regular person can follow. From a kid saving allowance money to a stressed-out office worker looking to grow their savings beyond coffee and takeout, these 3 rules turn investing from a scary monster under the bed into a friendly giant who just wants to help you build wealth.
bushels per acre of corn or soybeans, and you figure out how much that'll be worth, and then you figure out what the price should be. If you buy an apartment house, you look at what the rentals will be and what the taxes and expenses will be, and then you decide how much income you'll have, and you pay a fair price for that. But you don't In stocks, people, their neighbor whispers something to them and they run out and spend money that it took them years to earn. So you always want to look at the productive ability of the asset you're buying, whether it's a farm, apartment house, or a company, but the company is represented by a stock. And if you always get your money's worth, you'll do very well.
So next time you think investing is complicated, remember this. It's not rocket science, it's Warren Buffett's science. Stick to what you understand. Be patient like you're waiting for your favorite TV show's new season, and shop smart for value. Follow these simple rules, and who knows, maybe one day you'll be the one your friends ask for advice when they want to turn their pizza money into a fortune. Or at least you'll stop confusing investing with gambling and avoid making the kind of mistakes that have ruined more wallets than bad dating apps. Now, what are you waiting for? The market isn't going to wait forever, and neither is your chance to start turning pennies into something that looks suspiciously like financial freedom. Buffett didn't need rocket science, and neither do you. Just 3 simple rules, and a little bit of guts. Easy enough, right?